What's cracking, investors? By popular demand, I'm talking about Medical Properties Trust. Once again, everybody's favorite. I'm out of this position, however, I'm still keeping an eye on it loosely. I dug back in to try to figure out what the condition of the company is right now. Look, it's not pretty, a lot's going on, but I want to discuss really, after I go through the numbers a little bit, the crimes against shareholders. Okay, straight up crimes. Like, this stuff is just, it's to me, company, I want to give it to you right now. I'll give you all the reasons why. Uninvestable. I'm not saying it's not going to go up in price. I'm not saying that it's not going to make you money, especially in the short term, maybe in the next year or so. But for many reasons, I'm not touching it. I exited above the current price for a small loss, but I don't think I'm ever going in, and I'll tell you why. But let's take a look at some numbers and just take a brief overview as to what's been going on in the company recently. All right, and I'm gonna show you what happens when your number one and your number two tenants, the top biggest tenants, blow up and bankrupt, and why. I want to discuss why this is not a one-off, why this is going to keep occurring. There are many reasons. So let's go through the numbers first. What's been happening with the price of the stock? I think we all know. It peaked out somewhere, I don't know, around 23, 24. It's at $4 right now. Financials, quarterly, total revenue going down in the gutter. It's now pretty much half of what it used to be in its peak in 2022. Really bad. Let's take a look at some other stuff here, okay? Things like asset write-downs. We're going to be talking about that a lot. Look at this, billions of dollars disappearing. Poof, thin air. We're going to be talking about we don't need to do this net income stuff, right? Look at all these losses, because Slav, everybody knows that we look at funds from operations. Oh, you want to look at funds from operations, huh? Do you? Let's take a look at some funds from operations, guys. Oh, look at this beauty. Right? You want funds from operations? This is your funds from operations. Boom. Minus 454 million. Boom. Minus 779 billion. Boom. Minus 89 billion. Boom. Minus $494 million. How you like that, funds from operations? This is $2 billion here. Almost. That's the entire market cap of the company, guys. They just lost it in 4 quarters. In funds from operation. There's your FFO. All right? There it is. Let's take a look at some beauties, all right? Shall we? Take a look at some beauties. Property, plant, and equipment. 10 billion. 10.23. Okay? Total liabilities. 9.8. Almost the same figure. But what about cash? Oh, what about cash? They got no cash. $275 million. They have no cash. So we're really looking at like $500 million book value right there. I mean, it's insane. So you really got to be betting on a really good turnarounds. Crazy stuff. All right. Shareholders' equity by the books, $5 billion. Look at the shrinkage, right? At its peak at $9 billion. Look at the last 4 quarters. Boom. Minus 500 shareholders' equity. Boom, 500 million. Minus 900 billion shareholders' equity wiped out. Boom. Minus $500 million shareholders' equity wiped out. Boom. Another 700 or something $1 million of shareholder equity wiped out. Wiped, guys. They were supposed to take a big dent into the debt. What happened? $2 billion of sales. We took it from 10 billion to 9.3 billion to 9.2. They sold 1.5 billion here, and they managed to take the debt down by 100 million. What happened to the rest of the money, guys? What happened to the rest of the money? You know, when you're trying to pay off debt, not issue new debt. Why are we issuing new debt? Or you don't believe me that we're issuing new debt? Look at this. Net debt issued, and if it's negative, you know, repaid. Boom. Look at this. Okay, total debt repaid, negative. Look, long-term debt issued. Okay, total debt issued. Every quarter, we just issued $700 million in debt in the previous quarters. 2 quarters ago. Other financing activities. But the numbers, I don't even want to talk about the numbers, okay? Like, let's take a look at their 10Q, okay? Let's take a look at their 10Q for a moment, okay? Just to give you an idea of like what I'm talking about with this company. First of all, I want to show you this number. I don't know if you can see it. Net loss income, okay, for the 9 months ended in 2023, they made $107 million. In 2024, minus $2 billion. Minus $2 billion. Okay, now, fine. You think this doesn't matter? Look at the kind of like wording they have around their numbers. Okay, look at this. Just the top line, the very first thing you see, right? You open up the report. The very first thing is like, okay, assets, real estate assets. The very first line: land, buildings and improvements, intangible lease assets, and other. It's like, can't you guys break that down a little bit more specifically? I mean, is there like a rule against listing all these individually or something? Like, why does it have to be all bundled up like that? Like, how am I supposed to get what your buildings and land is worth? Everything is just grouped together, and underneath it doesn't break it down any further. Maybe there's a rule against it. Maybe I'm just being stupid. That's fine. Investment in financing leases. Okay, and then real estate held for sale, fine, and mortgage loans about unchanged. So negative almost $2 billion. So we've lost about $2 billion of land, buildings and improvements, intangible assets and other. Like, what is other? What is other? Cash hasn't changed, but somehow we've melted net investment in real estate assets. We've melted, you know, shareholder equity. We've melted total assets. We've melted buildings and land. Somehow the cash position is unchanged, even though the dividend's been cut like twice. If you ask me, just 2 years ago, the right move would be cut the dividend right away, rip that band-aid off, you know, stop footsing around, put more pressure on Prospect and Stewart to get their shit together right away. But it's not possible. Why? We'll talk about that later. We'll talk about it. Political stuff, okay? It's just a bad business model. All right? I'll talk about it in a second. I don't even want to go through the rest of this. I mean, you can find a lot of gems in here. You can find a lot of gems. If you break this stuff down, you'll see all the write-downs. There it goes. Real estate and other impairment charges, etc. You'll see where the money's been leaking and what's been happening. But really, I want to... one point I want to drive home. Look at this. So this website. It's called All REITs. And they got a 30 out of 100. Many of these categories, just this for comedic purposes, doesn't really mean anything. Normalized FFO growth, 0, right? Everything is at 0. The only things that are full is payout ratio, which is bogus, right? Obviously, payout ratio is not 32%. And then the other thing they got 30 on is years since IPO. The fact that the company survived, the IPO has been a long time ago. This is what they get a perfect score on. Everything else is 0, right? They get a 0 out of 15 or whatever it is. 0. Look at this performance. Adjusted for dividends. All right, 10-year performance minus 40%. How would you guys like to lose 40%, including the dividends, in 10 years? All right, here's what I want to talk about the most. You can look at this. The website's called REITs, and ALREITS.com. It's not substitute for research. You got to do your own due diligence. Okay, this is what I want to talk about here, okay? This company, in my eyes, you can take a screenshot of this if you want or pause it, but I'm going to put my face up and talk about it while I read off of this a little bit. The company, in my eyes, is uninvestable, and it's not because I don't think that there's going to be a pickup. In fact, there's been some, new tenants now in place of Steward. 2 of them, by the way, at least 2 have had financial trouble before, and in my opinion, are going to have financial trouble again in the future. So that's not going to be very pleasant. One of them, Honor, is actually a non-profit and has been pretty stable financially. But the thing is, these companies are going to boost the revenue, temporarily. Once the rent hits into the books, it's going to look great. And a lot of people are going to look at the statements and going to say, oh, okay, MPW is turning it around. Medical Properties Trust turned a new leaf. Everything's going to be fine. And it might look fine for a year or 2. I can see this going to like $6.50 a share or something like that. But then eventually problems are going to start arising again because of this. Number 1, okay? It's an unsustainable bad model. Okay, the whole company is founded on a bad model. It's politicized building under stress, right? So what do? Mr. Ed, he buys a building that belonged to a hospital and he leases it back to the hospital, right? So basically, even if their argument of rents not being so onerous to the hospital is still an extra 10% that they have to charge. They claim it's 10% of their bills is rent, which is still an extra 10%. Number 1, and number 2, they're just giving us this figure. Okay, Medical Properties Trust is just telling us this figure. I don't even know how accurate it is, and whether or not it's just for Steward or for all the other hospitals. But anyways, regardless, it's an extra burden for the hospital. Okay, somebody made out with the money. In this case, in Steward's case, De La Torre makes out with the money, or Cerberus, or whatever kind of investors that were involved in those deals. And now MPT or MPW is used as the funding bag for all this. And we're supposed to be getting dividends. We're supposed to be getting rent income from these properties by squeezing these hospitals' operations and having them pay us rent. But I think this is a very flawed model. For many reasons. And not only is it flawed, but Mr. Ed and whoever else is in charge of these deals, they arguably overpaid for these hospitals, right? I don't know what kind of metrics they used, but location is obviously very important here. I don't know if they used rent as a metric in order to value these buildings, and then they jack up the rent and value them higher. It's very hard to value hospitals because you have to value them against other ones and recent deals and so forth, but it's a very liquid and niche market. So reason number 3 here, a lot of them have to do with the CEO. He got in bed with shady figures, okay? Ed Aldag got in bed with shady figures. What's a shady figure? Mr. De La Torre, Ralph De La Torre is a shady figure. I don't know if he caused the bankruptcy of Steward because he's incompetent or because he's greedy. It could be a combination of both. Could be a spectrum, could be another reason altogether, but either way, that's not a good person to be in business with. And not only was Steward used to comprise 40 or more % of the total amount of hospitals with MPW. But in addition to that, Ed went into side businesses with him. He went into side gigs, right? They went all over Malta. They went all over like Southern America to buy up hospitals and do the whole like leaseback thing. They created funds that were funded solely by you, the shareholder of MPW. So I don't think this is a good decision. He's getting in bed with bad, shady figures, which screams bad management. Okay, he makes bad financial moves by extending and pretending, and by paying out dividends with money he doesn't have. He meaning Ed. And I'm gonna say he because he's basically controlling the company. It's his company. Extending and pretending. For 2 years, he's telling us, oh, don't worry about it. We're just protecting our asset. They're going to start paying rent soon, whatever. We're in talks, this and that. It's okay if they don't pay us this quarter. It's okay if they don't pay us this other quarter. And look, part of it is legit because these are very touchy subjects. You can't just, the moment, what happens, the reason this model is so flawed is because of the political aspect of hospitals and the amount of like non-market forces acting on it. I'll expand on that a little bit later, but it's so political because you can't really say, hey, pay me rent, all right, or I'm kicking you out. Now you look like public enemy number one. You look like the worst person in the entire world if you say, hey, you haven't paid me rent, hospital, so therefore you got like 3 months or I'm kicking you out, right? First of all, how are you going to kick him out, right? Second of all, you're going to make the news as, oh, one hospital missed a rent payment and therefore, Medical Properties Trust is now putting patients on the street, right? They're putting sick people on the street. How's that going to go over? Right? They're going to shut down the company. I mean, the government is just going to come in and seize the whole thing. I don't know. They're going to find him in submission. There's going to be like overhauling legislation. They're going to nationalize their hospitals. Who knows what's going to happen? But that's just the most evil thing that you could say, right? We're putting doctors out of work. And we're putting patients on the street. How's that going to go over? I'm actually amazed that they managed to win the PR battle with the whole Stewart bankruptcy. So this is the playbook, right? The playbook is you pretend and extend. You say, all right, we're going to make this adjustment for you. You don't have to pay us rent. We'll wait. We'll try to work with you. They work with you for a year, work with you for 2 years. And then finally you can present that like, look, we've made our best effort to work with these hospitals. They just cannot survive. They're going bankrupt. It wasn't our fault. We tried helping them. We even funded them. Yes, all these funding packages. Like, where do you think this money disappears to? They sell $1.5 billion of property and only 100 million gets repaid in debt, and then like 90 million goes to dividend. Where's the rest of the money? So they do all these deals. They buy their shares of their business in exchange for rent payments, and they accumulate this like zero worthless paper, right? So they do all these concessions and they work with them just so they can present that, just so they don't have to look like the bad guy at the end of it all, putting patients on the streets and doctors and nurses out of work. So I get it, but that's why it's such a flawed model. I would not want to ever invest in a medical REIT again, or anything that has to do with medical and hospitals, for that matter. Here's another reason why I don't like this. The CEO, Ed, does not admit fault where he clearly has misstepped. Therefore, he has no integrity. Now, I know that it's tricky sometimes to talk about public stuff, because of legality issues. But he made no attempt to take responsibility of his bad decisions, and they're clearly bad. Clearly bad. No attempt. Extend and pretend. Lie and confuse to shareholders that everything's fine, they're doing whatever. Like, try at least to give a hint to your shareholders, to your bosses, for crying out loud. You guys own him. Like he works for you, the shareholders. Okay, the shareholders are the owners of the company, so he's supposed to be serving you. And what's he doing? He's not even being upfront. He's not even take responsibility. I don't like that at all. I don't want to be in business with a person like that. Another reason, bad precedent is set with hospitals not paying rent and taking handouts. MPW prolonged the death of Stewart unnecessarily for years. Can't remove them easily without a press spin, which they did, because hospitals are politicized. This is what I just talked about. Another reason, there's no chance of removing the CEO. Like in some companies, maybe you can get like an activist something, get on the board, get everybody against the CEO. There's no way. The guy owns way too much of Medical Properties Trust. I think over 10% or something. And he keeps awarding himself, millions of dollars worth of shares. It's there. Let me see if I can find it real quick. I don't know if I can find it. It should be under the cash flow maybe. Where's the awards? Stock-based compensation. Look at this, guys. This is another gem. Look at this. $14 million, $14.5 million of stock-based compensation, the highest since 2022. And the stock's in the gutter. Why don't we award Ed with another 14 million? Okay, because he did such a fine job at getting, of losing $2 billion in funds from operation in the last 4 quarters. Fantastic. More compensation. No chance of removing him. Owns too much of the company. It's his company, guys. He founded it. He owns it. It's fine. Reason number 2, company is still in financial stress. Oh, I didn't show you this. Sorry. Here. Stock-based compensation. There it is. 14 million. Right? The highest since 2022, December, which was 16 million. All right, moving on. Company still in financial stress. They finally wrote down all the loss of capital. Usually they come in chunks. Finally decreased the write down the decrease in equity, which is those worthless. They didn't write down enough. I mean, the equity, in my opinion, is pretty worthless in these operators. I mean, what good is owning, a share of a company going through bankruptcy? That's gonna get wiped out anyways. Like, why? FFO is in the gutter still. Debt is still a huge issue. Cannot make a dent in the debt, right? They've only repaid 100 million in the last quarter. It's ridiculous after all these sales. Interest on debt increases, although at a reasonable rate. Shareholders' equity continues to dip and just melting. It's melting like an ice cube in global warming, guys. I mean, it's nuts. Current and future FFO look weak. Now, although, like I said, it might be a bump when the new renters kick in, but they're still going through problems with Prospect, etc. So it's just going to be their second biggest tenant is going to have some restructuring going on. There's a glimmer of hope. Some of the stress is due to REIT weakness and long-term interest rate spikes. That's true. Bonds been spiking and all of the REITs have been taking a hit. In fact, one of my largest holdings, Realty Income, is also taking a hit, which is, in my opinion, a very good buying opportunity. I have been buying a lot. I've been buying a lot of Realty Income. So hopefully that pays for me right later down the road. But anyways, back on topic. Massive write-downs usually clear the balance sheet, so they might look good in coming quarters ahead. But like I said, these problems, they're not done forever. It's going to happen to the new tenants, okay? It's going to happen to the new tenants. MPW hit a low quite some time ago. Yeah, I think the low for the cycle might be actually earlier in 2024. New tenants may boost figures. If when REITs catch a bid, the garbage ones usually climb fastest out of the gate. right? So if the interest rate situation improves, garbage usually flies. So this thing might double in short order. I doubt it's gonna have a sustained climb, just like a more high quality REIT would. But I think initial bump and then starting to sell off afterwards. Why I'm not going back in? The CEO. No thanks. Hospital REIT specific risks. This is the biggest deal. It's difficult to transact because the transactions end up destroying capital. There's political risks, and non-market forces work against the business. What are non-market forces? Non-market forces is basically everything that has to do with kind of just this inelastic inefficiency. So the biggest example that I could think of is reimbursement rates, right? Many hospitals are always blaming the reimbursement rates, especially if they have, low income clientele. The government's supposed to reimburse the hospitals for the missing money that the low income people can't pay, like through Medicare or whatever. And they basically blame the government for not giving them enough money. That's what it is. So these are non-market forces, right? The clients do not pay for the services. Some people walk into the hospital, especially in poorer neighborhoods. By the way, MPW owns a lot of hospitals in those neighborhoods. So a lot of the operators are, and it's going to be in the same boat, as they have to pay more for the doctors and nurses. Those guys are not taking any pay cuts. They're in short supply. As they're paying more for their doctors and nurses, they're going to have the same reimbursement issue as the previous tenants. They're not going to escape that. So the same thing is going to happen in a few years for the new tenants. The location and the rules are the problem, right? The tenants will inevitably be in trouble as well, the new tenants. The location and the rules are the problem. So it's a bad business to have. The rules have to change for these hospitals. Either the state has to pay for all of it, or there needs to be more free market forces. Maybe there shouldn't be a hospital in that location to begin with because of the market forces. But that's the problem. It's not like who the operator is. These hospitals there are going to have to be subsidized by the operator from other hospitals. You see what I'm saying? Like, there's no way they can turn it around. Just like that corner shop that you guys have, that corner coffee shop or whatever somewhere in the neighborhood that keeps changing ownership of who and what is going on there. Maybe they'll have a restaurant and that'll shut down. Maybe like a coffee shop will appear, that'll shut down. There'll be like a kebab place, that'll shut down. Then they'll stay vacant for like a few months, and then like a salon will come in, that will shut down. It's just a location. Like, unless you get a really big franchise, they can subsidize it or something. I don't know. No one's gonna make money there ever. Even if there's a ton. Oh, here's the kicker, right? The most important reason: if there is a ton of value there, and if the price drops low enough, right? If the market doesn't appreciate that, the whole thing can be bought out, guys, by PE, the same way it came, leaving investors with the bag. With the bag, guys. What does that mean? That means that you buy this thing at $3, $4. It drops down to $2. It goes private. It gets bought out. You're never going to see that money, okay? You're never going to see your $4 purchase. You're going to get half of that. Do you see what I'm saying? Okay, maybe the buyout is a $250. Still, you're never gonna see that money. Like, it's such a bad deal. I'm not going back in, even if the possibility that is gonna double in the next year or two. I'm not going back in. I'm not taking that risk. I'm not even gonna write puts. I'm not gonna do it. Any of that. I'm out. Why are you guys still in? Leave me a comment.